Welcome to episode 2 of Systematic Shenanigans. Now, as a pretense, this is just an informal conversation with two systematic slash algorithmic traders about the reality of trading. We try and take away all the flashy parts around of trading and just, give our topics that we've been paying attention to this week. Sometimes that'll be because of current events, or if there's a particular topic that we'd like to discuss and kind of share with you guys. Now, we had amazing feedback from episode 1, so if you haven't checked out episode 1, feel free to watch that after this episode. First topic for this week is, at least from my notes, is stopping strategies. I did a couple Q&As recently, or just I was talking with some traders, and a lot of them asked about, like how do you know when a strategy stops working? And my first answer from all of that is that's the $1,000,000 question. It's a very difficult thing to answer. So I wanted to give at least my take, and I want to also hear your thoughts, Padma. But for me, I try and split it down into two paths for ideas that I know have long-term kind of either proof, or they just have a long-term risk premium or inefficiency that I think will always consistently work and is being proven to work. And then I have the second group, which is like short-term edges, where there isn't as much proof, and it's most likely because of a market regime. So a really easy example of this is like, trend following. We know trend following works. It has worked for years. We have seen many hedge funds work with trend following. There's lots of data around trend following. We know it works. So even if you go into, let's say, a year drawdown or multi-year drawdown, you can still have quite a lot of conviction for a trend following approach, especially if you're doing a simple trend following approach. But then on the second hand, like how we were talking on last week's call, if we did a strategy around new listings on Binance and shorting them because we think there's so many new coins being released and they're an easy short opportunity, if that suddenly stopped working, then I wouldn't be having the same conviction as a trend following approach that has been worked for years. So that's normally my take, because I think every other strategy to determine if a strategy isn't working anymore either makes you abandon the strategy way too early, or you already abandon it just way too late. So at least for me, I try and split it into those two groups, and then I can be more strict on if I turn off a strategy or not, if that makes sense. But what are your thoughts?
Definitely, this is one of the hardest questions, right? When do you want to stop a strategy? So it's probably the most discretionary decision that you'll make within a non-discretionary system, right? Because as far as I know, there's no real a set rule. Like it goes to a drawdown of 30% and you take it. There's no rule like that. So I'm also of the same opinion of what you just said. There's two types of strategies. Let's say that you have some strategies that we have very clear benchmarks to a risk factor. For example, trend following, you have momentum, you have value, you have a bunch of different stuff that you can trade or be exposed to, let's say. And if suddenly you start going through a drawdown, at least you can compare your own model to whatever beta do you have with that model. So, for example, if you are trading momentum, let's say in US equities, you can benchmark your own returns against the other momentum models, and try to figure out if the reason for underperformance is you, or if it's the general tendency or the general returns of that risk factor that you are exposed to, right? So you can get very clear benchmarks that way. And maybe if you start to decay, if your signals, you shouldn't be trading single signals anyways, but if your signal starts to decay compared to other signals in the same space for long periods of time, however you define long, then you start to wonder, maybe my approach is not the optimal solution for this type of strategy that I'm running, right? And you can benchmark it that way. But if you are trading, like you said, Munir, specific alphas or things that you can't really benchmark for example, shorting small caps, or you have some sort of system that you really can't benchmark because no one is doing it. It's pure alpha. Let's say that it's pure alpha and you can benchmark for it. Then it starts to become more of a problem of around, okay, does the phenomenon that influenced this alpha that I have is no longer there, and you need to start doing theories around that. And maybe if it goes through a maximum drawdown of historical whatever you had, maybe you start to consider shutting it down and opening back up again once you get a clear idea of where it's headed. And then to me, there's even a third category, and that is strategies that are reliant on a price, let's say, that where you derive your alpha or your returns is clear. For example, you have an arbitrage across exchanges, right? You have let's say you have a 10% arbitrage from Binance to OKX. Obviously, this doesn't exist. Then there it's clear. If you don't have any more that arbitrage, you no longer have a strategy to be doing. Or if it's not enough during the month or something like that, and your capital is no longer optimally exposed. So there's a few different ways you can look at it depending on your own style of trading.
Yeah, I agree. The only thing I would fight back on that would be I think small caps is something that's a bit more long lasting. We kind of talked about it last week, was like fundamentally the kind of trash companies that are getting busted up because of some sort of news. So most of the time they'll fade. So I do think the edge will kind of stay for a long time, I would assume. Like it's stayed for quite a long time already, but maybe I'm not, it's maybe not completely true. Obviously, compared to like trend following, it's definitely less proven, I guess you'd say. And then the only thing I actually wanted to add to that was you can look at degradation of predictability. So this is more of mean reversion strategies rather than trend following. I don't think it would work as well, but you can look at like key metrics like win rate, right? And the characteristics of a mean reversion strategy should be often a higher win rate, right? Like you're not trading a mean reversion strategy that's below 50% win rate. So if your particular mean reversion strategy really degrades in performance on that particular metric, and that's a key characteristic of that particular strategy type, then that can show you that maybe this approach of mean reversion is no longer working. Obviously, you still need big enough sample. I'm not talking about a day or a week or whatever, but I think that's one metric I've personally used before, and that can be a good way to see if that particular way you're doing that particular strategy type, if it's like continuing to work. Would you agree?
Definitely, but that comes at the conversation of economic rationale behind your system. Because, for example, on that small caps example you used, it's clear that the economic rationale there or behavioral aspect of the trade is that someone else is going to be selling into the buying pressure there, because there's economic or fundamental, whatever you want to call, reasons behind that trade. And that makes sense that if companies continue to be trash and companies continue to do PRs to raise money and stuff like that, that edge will continue as long as those parameters are there. So I would be more confident in betting in that inefficiency, let's say, or that edge. I completely agree. But let's say that you find an alpha that you really have no economic rationale for it, but it's there, it's clear, you can see that it's something persistent. How would you proceed there?
Yeah, I get what you're saying. That would be a lot more difficult because like for something that has no underlying, then I would be primarily just looking if performance degrades a lot.
Exactly. And you can see that, like you said, for example, you use the example of the win rate. I usually tend to use the example of the Sharpe ratio. You can see that the Sharpe ratio of a momentum strategy 30 years ago was much higher than it is now. A strategy decay over time. People start to concentrate on those positions because they know they make money, and then the edge starts fading away, and that's natural in markets, and you have to adapt like any other business.
Yeah, I totally agree. For my second point, I actually want to talk about was the pros and cons of doing advanced techniques. This was another thing I just heard on conversations with other traders, and a lot of them were either looking into or asking, is it worth doing more of these advanced techniques? And I'm not talking about techniques like, I don't know, Monte Carlo simulation and walk forward optimization. In my opinion, maybe they're advanced for when you're getting into trading. I agree. Most people haven't heard of them when you're, first year of trading or something like that. But for hyper advanced, I don't know if hyper advanced is the right word, but for more advanced from there would be like permutation or like creating fake data and things like that. And at least in my opinion, for most retail operations, you're never going to have to be that advanced. At least in my opinion, it doesn't add to your performance by such a marginal amount for the amount of effort you have to put in, if that makes sense. There's just too much opportunity cost there for spending so much time to create, statistically correct fake data based on your particular market to do that advanced technique or whatever other like advanced technique to actually make it improve your performance. What do you think? Do you like, I know you're pretty simplistic with your back testing, like you do some things here and there, but what do you think?
I'll say just what worked for me, right? That's the only perspective I can say, and then I'll comment on the more advanced stuff. But my comments are not based on experience. My experience has been to simplify most things, right? If you follow the Pareto rule, right? 20/80.
Yeah.
Most retail traders have much more low-hanging fruit on simple stuff, on doing simple arbitrages, running some momentum models, collecting risk premium, whatever it is, like simple stuff that doesn't require a lot of complexity. And they haven't even done that because they don't make any money. And complexity shouldn't be a conversation until you have that fixed, until you have perhaps a diversified portfolio of a few different strategies. I don't say a bunch of them, but maybe 2 or 3 uncorrelated strategies that produce you some income on a regular basis. And then you can start building on top of that, but very carefully. And in terms of complexity, I would say that most retail should avoid it, because they will completely mess it up and they'll end up overfitting and doing a bunch of wrong stuff instead of focusing on the basics and be really, really optimized on the basics, let's say. But there's definitely advanced techniques that if you add it, maybe you add like 1% or 1 or 2% to your P&L at the end of the year. Maybe for a retail trader making $100,000 a year, 1 or 2% is not much. And maybe if they spend time probably on portfolio management or other stuff, they probably make a lot more returns there by spending time really thinking and digging into that data. But for a massive firm or someone more sophisticated, maybe that 1 to 2% on a $1 million or $10 million P&L a year, that's already significant. So it really depends on the trader and their capacity. I would say for the vast majority of retail traders, like 99%, focus on the basic stuff, make it more efficient and maximize it to the maximum capacity that you can. That's the low-hanging fruit, in my opinion.
Yeah, no, I think you put it a lot better than me. That's kind of what I was trying to explain, is that for, enterprise, doing these more advanced techniques totally makes sense, right? Because, a small marginal increase could be millions, right? Depending on how much capital you're managing. But for most retail traders, you're not going to be managing that much capital. So you don't need to be doing the most complex techniques to have the fully most accurate, portfolio management, etc., and things like that. You can just focus on the basics and improve the efficiencies of those. So yeah, I completely agree. Like, the only time I've considered doing advanced things and why I brought up fake data was because you do sometimes get those cases where you have a strategy that does seem to work, it seems promising, but it's a very low sample strategy and there's just not enough data to run over it. And those sort of situations is where potentially you can get some benefit. Like I remember we were talking about it a long while ago, but that Ernest Chan
Yes.
lecture, yeah, like that sort of stuff seemed very interesting to me. And for a time I was like, oh, maybe I really sit down, do the maths, and try and work that stuff out. But after trying it myself, it just, the marginal increase was just so small. I just wasn't managing enough money where it would make much of a difference. Like there was, as you were saying, there's just better stuff to work on that could have made me a lot more money than trying to do stuff like that.
Exactly. Like I don't. I think those projects are interesting, and I've already went into a bunch of rabbit holes like that. I built an entire genetic algorithm, like to find strategies from scratch, and it took me so much time. But did that make me money? No, it didn't. I focus on simple stuff, what you can control today, and that's it. If you want to go on random rabbit holes in the future, once you have everything established and you're already maximizing whatever capacity you have for your edge, awesome, go for it. But I think that most retails are not there.
Something about that actually is, I don't know, it made it completely click in my brain. For those that don't know, I help run and develop Ask Edgar. And I feel like Ask Edgar, to me, it's actually, to give a bit more context, it's like an AI SEC trading research platform. And for me, that's sort of where I can do my rabbit holes, right? And we can try out new things. A research platform that other people use, those advanced sort of techniques and things like that have been instrumental. So yeah, I think if you're a developer listening to this, try and maybe get yourself like a side hobby or of something that you can really do rabbit holes down. Unless you can still do the rabbit holes on trading stuff, just don't expect it to actually improve performance by that much. Because as Penman was saying, most of the time it really doesn't. For
Yeah,
my last note is, I was thinking about this today, and it's a topic I always go back to every once in a while, and it's that conviction is the majority of, in my opinion, psychology. It's also the majority of trading to some essence. Well, obviously, you do need an edge, and that always comes first, and things like that. The part after that is conviction. If you don't have conviction to be able to either execute or to leave your automation to execute and things like that, that's where all the errors come in trading. And from my personal journey trading, a lot of the time has been dedicated to building my conviction up in a strategy, whether that be spending a lot of time backtesting, spending a lot of time making sure it's a sound approach, making sure I have enough data, etc., and then also slowly scaling it on live, which slowly then builds my conviction even more with that particular strategy, and also builds my kind of confidence with handling the volatility of it. Because without that, I know many traders that have had a decent edge. They just have completely messed up because they lost conviction. Or you can have the other side of it is you can have maybe too much conviction and they've pushed way too much size, and they've pushed too much size where they've had to, revert back to either, building a capital again by working a job or things like that. So a lot of the time, I think after you've got your edge, most of it comes down to conviction, at least just in my opinion. What do you think?
Yeah, as you were speaking, I'm remembering a tweet from Robert James, like with a chart. I'm not going to say the words here, but it's like you have on the left, you have like being a wuss, right? On the right, you have like being what word do I know use? Being stupid with your allocation. In the middle is where you should bet. All right. So it's the same. You should be convicted about your own work on the system, let's say, but at the same time you shouldn't. I talk from my experience how I trade. I see it this way. I'm very convicted about my work, the work I've put into the testing, into the understanding the edge, the economical rationale behind why I have this exposure, why it should continue, etc., etc. At the same time, I know that the market is very fickle, right?
Yeah.
It's always changing. Statistical relationships in the market between different things are always breaking. New regulations come in, new environments. So I'm confident in the work I've done, and with results that you get from your own live trading and from actually money that you make through this, you start getting more convicted in what you do, at least as some economic validity, right? But at the same time, I'm not convicted in the market, if that makes sense. The market changes, and I must always continue to be thinking and adapting to whatever it is changing. So it's a weird dynamic, but it's the dynamic of a trader, in my opinion. Being convicted of your own work, not being convicted the market will give you what you want. I think that's it.
I think that's very well put. That actually, like, just side note here, it kind of makes me think about what parts of trading as a career you should kind of derive your happiness from. I've seen a lot of different takes on this. Obviously, I'm just saying this is my personal take, but I try and derive a lot of my happiness from the actual research. And like Pedmo will know, like I'll send him a random thing that I think could maybe work at like 2 a.m. and then he'll respond when he wakes up at a sensible time. And things like that I think is where I've tried to find the most happiness. Obviously, having a record P&L month or hitting an amazing trade feels great, but when you do derive happiness slash I don't know, like emotions from those sort of things, you'll end up, as Pedman's kind of saying, like you'll end up on one side of that bell curve where you're going to be either way too convicted, and then your next like 5 trades you're putting on way too much size, and you're losing more than you should, or if you're taking a losing month and you're then really scared of everything, then you're going to be on the left side, right? So I don't know, where do you get any certain happiness from trading, or like how do you kind of deal with it as a career?
I would like to say that I get nothing. That I'm completely neutral, and in most cases I am. But when you hit like a record month, or on the opposite, when it's one of your worst months ever, you feel something, right? But over time, I don't know. If you were with me, like if you were my family or something like that deals with me every day, you wouldn't even notice if I had a good day or a bad day. I don't care anymore. I do feel when it's at the extremes, like I said, a really good day or a really bad day. I do feel it. Of course, I'm human like everyone, but over time you build this, I don't know, this neutrality to the daily swings, because most of the time it's neutral. You are not making money. You're probably losing a little or making a little, at least from trend following, the way I trade. And then there's a few times, once a year, twice a year, that you're making really good improvements. And so if your happiness is derived from those small periods of time in the year, then you are never happy. So you have to find happiness or fulfillment, let's say, through your own research, through your own work, outside of the actual volatility of the market. And that's what I focus. I really enjoy the research process. I really enjoy like even today, I saw this protocol, Phantom changed into Sonic or whatever, and they have a bunch of these new farms that are also at the same time earning points, so that one day you can maybe be qualified for their airdrop. And so I was reading all of their documentation and see how the protocol worked and stuff like that. That stuff is interesting to me. You know, it's just a daily routine of checking new things and learning. That's where I derive fulfillment.
I agree. I also think it's very valuable if you can find other people you can talk about with trading, because like I get a lot of, I guess, happiness in some way that, like, talking about trading with you, discussing different topics, things like that. And it slowly weighs me away from, like, just P&L focused. Whereas, like, if you're the only person you're trading and you're just every single day you have to wake up and look at your trading, it can become a bit of a slog, I guess, just to deal with like P&L volatility and things like that. But I'll let you get onto your notes because I know you have a couple good notes here. So what one do you want to start with?
Yeah, no, yeah, that's a good point. I would start with that one comment around the statistics last time. I think it was an interesting one. He basically said to us, like, good talk, but please stop talking about statistics if you don't know how the numbers are made. 99% of traders fail. What are you talking about? You know how these numbers are calculated based on 500 deposit, 30-day periods, newly open broker accounts. Okay, even if that's true, I heard something around it. I don't care that much, but even if it's true, if it's only based on short-term accounts, let's call them, even if we remove from them, I'm still willing to bet that the large majority, I would say even over 95% of traders that even do this for a few months, that even have some initial motivation to do it, still fail. You can check any data. You can go to these decentralized exchanges and check the data on the returns of the traders. Most traders are net losers, trading against the best in the world, the most sophisticated people in the world, looking for edges and looking for a better execution than you. Okay, I'm not saying it is impossible. We do it. We actively trade and we trade profitably. And you can go to places where there's less competition and stuff like that, stuff that we talk about. But in terms of the majority of the bulk of traders, I would be really surprised that even if you take those short-term deposits, like I said, that you would still have something around below 95% of traders that would fail. I think the number should be around the 95, 97, and even higher. But and if you talk even about the people that make like 100,000 a year or something to justify the effort that it takes, those numbers are even much lower. So
I totally agree. Like my favorite chart that gets posted on Twitter every once in a while is the hyperliquid chart. You know, the P&L
yeah,
chart. If any of you are listening to this, look up hyperliquid. I think it's like hyperliquid stats or something, and you can see their active P&L chart, and it's just straight down. It's actually impressive how, more than 99% of people in hyperliquid lose money trading. You can also, like, I referenced him in a comment on the post saying that, like, you can look up even pump funds. Like, the best thing about crypto, in my opinion, is that you can look up all these exchanges like stats for the most part. Like, you can look up pump funds and they release how many people are winning on pump fund and what percentage that is, and it's a very, very, very small percentage. Even if it's, as you were saying, even if it's a difference of a couple of percentage, overall the theme is still that most people lose. I don't see really how you can argue against that. Your next topic.
The next topic is around the importance of accurate backtesting. Maybe I'll start with a question to you. Like, you are more in the space of backtesting and everything. I do a lot of work there, but you are more like even working with traders and doing a lot of work. What do you think about when you go on Twitter or on YouTube and someone shows you a backtest of a trading system? What do you think about it? Like, what's your first reaction, let's say?
Interesting question. Okay, well, first, I would say now, I can kind of detect what a strategy is, slash, if it's potentially overfitted from just the equity curve. So a lot of the time, also a big one is by noticing the platform. So if someone sends me a trading view equity curve, automatically 99% guess it's overfitted, doesn't work. It's on simulation bars, meaning that, like, it's simulating order and fills. There's no slippage, there's no commissions, etc. So most of the time when I see a straight up backtest, I'm more wary than trusting of it ever. Like, if someone sent me a multi-color simulation, proof that out of sample, in sample, that sort of stuff, then I'm more like convicted that it's maybe a strategy that actually works. But if you just send me an equity curve, most of the time, I would say it's overfitted.
Yeah, definitely. It's like I don't know who I was talking with today about that, but I don't trust any backtests. Like when I see them, I've literally put hundreds of hours behind my own backtesting infrastructure, and hundreds of hours reconcile tests between all the chain of events of a backtest until it leads to an ultimate outcome. Because it's very different. So you testing a backtest on a bit on like a S&P 500 strategy and an end of day strategy. Other thing is like managing a multi-strategy portfolio, managing a lot of assets at the same time, a lot of time frames, dealing with daily inventory. What I mean by this is that you have to track every day what positions the model has, simulate for that, the cash that you had on hand, the cash that you had deployed, the cash that you had unrealized. All of that stuff is so complex when you get it done that I don't trust any backtest. That's why you see so many backtests and websites with backtests, and none of them, like if you check for live returns, no one can produce live returns. It's so important. A backtest, even though I think that there's better ways to understand if the edge is right, if you get your backtest wrong, you'll have a hard time. You'll have a hard time overall in any strategy that you deploy.
I agree. I think like to give a bit of context, because I do occasionally put out strategies with equity curves on Twitter and things like that, so I want people to understand the context of those. Is like I don't think there's anything wrong showing a a backtest equity curve on Twitter or whatever on your blog. I think that's totally fine. There's like nothing wrong with it. But to properly either advertise, I guess, in a way, or say that you've tested a strategy, especially if it's going to be for yourself. As Pedman was saying, there's so many factors. Like I remember, like we were talking about it recently. Like I was doing a back test of a crypto strategy, and it was doing shorting, and I had to do like the funding rate. That funding rate code was a pain in the ass. It was annoying to do. And even after like 3 iterations or whatever, then I finally got it to where it's pretty accurate. And then I'm lucky that I know while it may not be 100% accurate, it doesn't need to be 100% accurate in that case, because I know I'm going to be pushing it on bar close. I'm not going to be pushing incredible size where that sort of funding rate is going to make a huge difference. But like if you're pushing serious capital, that's where these backtests need to be incredibly accurate. And also, actually, a good point you made there is like, the reason I haven't advertised, I get it's actually an insane amount of Twitter DMs of people saying like I should advertise their backtesting platforms, meaning like those platforms where you can put in an indicator and you put in your little check boxes of like this above, this below, etc., and then generate returns. They are great for starting out. I think it's good to play around with, but when you're deploying something seriously, you need to understand every assumption. Like even using Python libraries is sometimes dangerous. So like that's why both of us, at least to my knowledge, like we both use custom code for the most of it, right? I think I use like a FFN for performance outputs, but that's pretty much it. Everything else is custom. And the reason I do that is because then I can understand everything that's going on in my backtest. And also that means if I need to add something specific, because for a specific strategy it has a funding rate, I can add it to the backtesting side of things. But yeah, I don't know. What do you think?
Yeah, completely agree. Like every single thing on my backtest is custom made. Every single thing, like from the initial cent, let's say that you use $100 to start, to test a strategy, to the single cent of $100, it has to match until the end. Like every day it has to match. So when I post a backtest, and like you said, I have nothing against like people posting backtests. Of course, I do that. I post on my blogs, my research, and everything like that. I'm just saying I don't trust them because I know how much work it is. I literally spend hundreds of hours, if not 1,000, but I don't want to exaggerate, like just building backtesting infrastructure. And by the way, with this, I don't want to be one of those guys that is telling you like this is too complex for you to do, don't even try. I'm not saying that. When I started to trade this model that I currently trade, this momentum model on crypto, I didn't even have a backtest for it. I just started trading. My best models have been found just trading the markets. Okay, there's a difference between trying to grow and trying to allocate more capital and be more careful or more mindful about your exposures and getting that through a backtest. And other is getting just an idea of if the edge really works and if it is exploitable. Those are 2 different topics. I'm not going to get into it today, but yeah, I'm just saying that for a true accurate backtest, you have to be very careful what you see online, unless it is from trusted sources, from people that actually trade. That's how I do it.
I would also say like I guess the overall lesson from this particular point is that if you see a solid equity curve out there online and they're giving away the strategy criteria or they give something away around it, then go test it yourself as well. And I think that's kind of what the most important thing is. Let it spike your curiosity. Let your curiosity, let you test out that idea. Just don't trust that equity curve fully. Because I do get sometimes, occasionally people will come to me and that they'll hand me like a research paper or like an academic paper that's out there, and they'll want to automate that particular strategy straight away just based on those results. And most of the time, my first thoughts, unless I know that research paper, is we should test this first. Like we should do our own, verification, independent verification of the strategy criteria, see if it actually is profitable. Because even academic papers are not flawless. Actually, most of them are not flawless. Most of them try and maximize the returns in some way. They don't tell you, the iteration cycles. They don't tell you the optimization cycles. You really do not know, even by reading a good academic paper, unless they tell you everything that they have done. I would always, verify it independently, test it yourself, and then go from there. And just another point on that is, I won't reveal how much like portfolio you're managing, but for Pedma, if you're going to scale at Pedma's rate or at size, you need to have these accurate backtests, right? Like backtesting is incredibly vital for those sort of things. But as you were saying, like when you're starting out and let's say you're doing like a $2,000 account, something like that, you can just test a strategy live with a small amount, and then if it seems somewhat profitable, or you can even do a manual backtest as well, just to getting, at least starting out, maybe do 30 samples, 50 samples, and then from there, then you can dedicate more time to a proper backtest. And even then, it doesn't need to be the most perfect slippage model ever, because you're trading a small account. You just have to work within your kind of constraints and then kind of grow from there. And then as you grow, then you can allocate more resources to more accuracy of different things.
Completely agree. I just added to next week notes because I could do a full podcast episode on this, of testing in production, testing in the market. That's so important.
Yeah, like, sounds interesting.
That's one of the things that I would stake everything on, because most people, like, you go on Twitter, on algo trading Twitter or whatever, quantitative Twitter or whatever, and you see so many people overcomplicating the smallest of things, and then when you ask them for, okay, but how much have you made from this work, all of these hundreds of hours you put, I'm still waiting for this and that, and you are like, what's that? That's nothing. The market went up 50% in the time you were working on your little optimization. It's like, do what works today. Simple stuff. Even if you don't have a backtest, okay, don't take this as advice. Always make your own, the disclaimer. But what I'm saying is that you are paid to make money in the markets, not to be smart. And you are not going to be the smartest at this game.
100%. I think, like, while it sounds like Pedma has a vengeance for it, like I've heard similar things from like Ernest Chan on podcasts and things like that. Like most of the time, actually going out and testing things, live capital, things like that, work really well, at least as a starting place. But okay, well, what's your next topic? Because we'll leave that for next week on testing and production.
Okay. The conclusive one that I would like to talk to you about and see your thoughts on it is, how many strategies should a trader have in their portfolio? I think this is an interesting topic.
Damn, good question. I will say, first off, I don't really know. I don't think I have like a number that jumps straight to head and I'm like, you need 10, like right now. I know a lot of the benefits from diversification come quite early on. You don't actually need that many strategies to get benefits from diversification. A lot of it comes from, like, if you only have one strategy, that's where you have the most risk. So if you even diversify to like 3 strategies, you're actually getting a huge marginal increase, if that makes sense. But I don't know. I know one trader that has like 30 strategies, and that's an insane amount to be running, especially as retail. My guess is going to be around like 5 to 10 is probably where I'd say like a lot of the sweet spot is for the most part.
Yeah. I agree. When I hear people say, I have 50 strategies running, like a guy I saw on a podcast a few months ago, I'm like, no, you don't. You have probably 3 or 5 that contribute the majority of the returns to. Like, you have 50 variations of the same idea, basically. You don't have 50 income streams. I'm sorry. You probably have 20 that are momentum, other 20 that are somewhat mean reversion, and another 10 that is something else that is not doing anything there. And That's just a reality. People are just, it's like me saying, okay, next week I launch a model that is a moving average crossover, the 20 and the 50, and then a 50 and 100, and then 100 and 200, and I have like 3 models running. No, I don't have 3 models. I have 1 model of momentum with 3 variations. Because you always have to think about both the correlation of returns, your overall portfolio, and then also the beta of the returns to whatever you are exposed to. In this case, in this example that I said, the momentum factor. And when people say to me, like, I have 50 strategies, no, they don't. They have a few strategies and a bunch of variations. But yeah, I agree with you. But I still do believe that a little bit less, at least for most people, than 5. I would say maybe 3 strategies that are truly uncorrelated. Maybe that's the sweet spot for me. And getting really specialized there on those 3. And you have something really interesting on your portfolio. But I do agree, like 5 to 7, do very robust stuff there, and you can do it on an automated portfolio.
The only way I could see you to have a lot of them is if you're someone running across like multiple markets. Like if you're doing like even this sad and annoying thing about correlation is that during those stress events where you want correlation, everything just kind of becomes correlated for the most part. So like I used to be more of an advocate, or not advocate, but like I used to think that, okay, I'm going to diversify a lot. Like I think you could probably look in some of my older YouTube videos, and I was like going to say I was going to build 20 strategies, 30 strategies, whatever. Now I have around 10, probably around 8 or like actually taking trades every month. And I want to build more, but to actually find more that like work and actually improve performance is kind of difficult. Especially that aren't just like basically, as you're saying, like the same approach. So more for what I'm looking for now is like diversifying markets. So like that's why I've obviously been trying to do like crypto stuff, and then maybe even things like corn, etc., those sort of markets. Then that gives you some more diversification, where you can split up those strategies among them. So I think that can maybe work. But yeah, I agree. I think at least when you're getting started, you don't need more than 3 for a good while, I would say.
Completely agree. I think that it's the thing that we talked about earlier in this call. It's like, where is the low-hanging fruit? And I think that the low-hanging fruit is you're doing 3 to 5 things really well, understand it to the core, that are uncorrelated, let's say, or less correlated to each other, and then trying to branch that out to other markets, because that's where you're going to really get the juice for the risk that you're putting in the market. Yeah, adding 10 more stuff that is the same, like into a soup. Yeah, awesome. But you're going to have you're going to have a nightmare to manage in terms, if you make it automated, let's say.
That's true. Well, if you're running 50, they have to be automated, I would assume. Doesn't?
Yeah.
I don't know how manually you would do 50 strategies, but I'd assume it has to be automated. But one thing I did actually want to put, because I know someone's going to probably comment it or think about it, is the only reason there you would have way more is if you got a lot of capital. Because there's definitely an argument to be made that like you couldn't diversify enough capital over 3 strategies, if you get what I mean.
Yeah. I still think that it is not a number of strategies question, but it is how many uncorrelated sources of return you can add.
That's true. I guess if you had the same strategy but you deployed it across different uncorrelated instruments, then you could still deploy a ton of capital.
Exactly. Even on crypto, if I have a bunch of signals for a trend following strategy, let's say I have a trend following strategy running, but I have 5 or 10 different signals, whatever, on different time frames and stuff like that, you are still like decreasing that slippage factor, because you are splitting your capital, the allocation between different types of signals in different times, right? And then if you go even broader than that, and you start to deploy capital in different exchanges, then you're diluting it even more your impact, your market impact, and stuff gets better. It's the low-hanging fruit that we talk about.
No, that's actually very true. That's very true. I probably wasn't thinking about it in the same manner, because yeah, if you just had enough instruments, you would be fine. Do you do anything? I don't know. As a last question, sorry, this has been running on for a very long time. As a last question, do you do anything to reduce your exposure during those stress events? Because everything just becomes kind of correlated, or what's your kind of approach?
Right now, I run just one momentum model. Like I said, it's just one trend model in my own portfolio, and it's crypto trends. And I don't reduce any exposure. Usually my model reduces exposure as the market becomes favorable to it. I've never had like a day where I was like shocked, hey, damn, I have such a large drawdown. I never had a day like that. The strategy is pretty good at managing that side of volatility.
Oh, fair. Just to also, I think some people are going to have the question, when you say one model, you do have multiple signal criteria though within that. It's not necessarily just one particular criteria.
Yes, I have different signals within this one model.
Yeah, okay, cool. All right, yeah.